All right, everyone. Welcome to panel 2 on digital assets and stablecoins. I'll just introduce our moderator, Amit Seru. Amit is the Stephen and Roberta Denning Professor of Finance at the Stanford GSB, a senior fellow at Hoover and here at SIEPR, and a research associate at NBER. His research focuses on financial intermediation, regulation, and technological change in finance. When he is not doing research or advising central banks and regulators around the world, like the BIS, Federal Reserve, ECB, and IMF, he is chauffeuring and otherwise caring for his 2 children and husky shepherd mix named Mittens. He told me before the conference that he has a hard time convincing his kids and his dog that financial regulation is interesting. I told him that wouldn't be a problem for this audience, and that after this panel, even Mittens may come around on stablecoins.
Thank you, Ramin, for the invitation to moderate this very interesting panel. So what I want to do is set the context for what our discussion is going to be, and then hand it to the esteemed panelists to give opening remarks. So as you know from the panel's title, why are we talking about this? Because financial systems right now seem like are at a point where we are going to see some evolution. It usually happens when technology changes. Historically, the cost of moving information, people call it sometimes coordinating trust. Sometimes people have talked about easy ways of transferring value. So whenever technology has done that, we have seen major changes. It seems like stablecoins and tokenized assets do represent potentially such a transition point. So here we are. You will see advocates, if you have followed this, arguing that these systems can modernize payments. You can have settlements 24/7. There is potential for interoperability and global access to financial infrastructure. But you probably have also seen critics argue that they are basically going to recreate the familiar fragilities, some of which we saw in the first panel getting discussed, in new forms. You're going to see runnable liabilities, you're going to see opacity, you're going to see fragmentation, you're going to see regulatory arbitrage with these things, and maybe faster because now it's going to be on technology and blockchain. Regardless of where you stand, what makes this moment pretty interesting is that this debate is no longer about the speculative crypto assets only. As you all probably know, this discussion is shifted to things like tokenized dollars, tokenized real assets, and the possibility of integrating blockchain-based infrastructure into the broader traditional financial system. So the key question is no longer whether these technologies work, but the bigger question is what's going to be the institutional and regulatory architecture that will allow innovation on this new front while potentially preserving trust, resiliency, and financial stability. So that's the context. So we have a terrific panel with very different perspectives on this question. So let me introduce them briefly. So Horacio Diaz Adda is the head of finance at Paxos, which is a regulated blockchain infrastructure platform behind products including PayPal USD, with experience navigating the intersection of global payments, stablecoins, and financial regulation. So he'll bring that perspective. We have Homam Maalouf, who is the Chief Product and Data Science Officer and co-founder of Lead Bank, where he focuses on connecting traditional banking infrastructure with digital asset and blockchain systems. So he'll bring the last mile discussion into our broader conversation here. And then last but not least, Hilary Allen is a law professor at American University, Washington College of Law, and one of the leading scholars looking at legal, regulatory, and financial stability risks associated with crypto markets and stablecoins. So what I've asked each panelist to do is to spend about 3 to 4 minutes briefly talking about a bunch of things, but hopefully focusing on what are these technologies trying to solve, what is the biggest opportunity or risk, and one policy challenge they think we all are underappreciating. So will that set the tone, and then we'll have a moderated Q&A with me, and then we'll open it up to the floor. Okay? So with that, the floor is yours.
Thank you. Thank you, everyone, for being here. It's a pleasure to be back at Stanford after many years. I was normally across the street, so it's great to finally fulfill the GSV. Finally, it's great to fulfill my dream to be on the more academic side of this ball. One aspect about stablecoins, we're all very excited about stablecoins because they represent the ability to move money globally, instantly, and very cheaply. And that's a promise, and why so many people, including myself, have dedicated large parts of our careers to them. For stablecoins to really fulfill that promise, they also need to be regulated so that they are stable, legal tender that can be accepted across the globe. And in many ways, you can think of it as bringing Zelle or FedNow, UPI in India, and PIX in Brazil together. And that's why it's such an exciting piece of technology. However, I'll try to move us along here. As regulation has started to come into the stablecoin space over the last few years, there is actually like a pretty significant threat in some ways against the global aspects of stablecoins. If you think about regulation started in MiCA in Europe, in the US, now we have Genius. Singapore, another major financial market, is in the process of introducing regulation around stablecoins. All of these frameworks are regulating somewhat similar risks, but in very different ways and from very different perspectives. And this creates tension with the concept of a global stablecoin that can be accepted in any part of the globe by any consumer of financial services. So an aspect that around global financial regulation that we've been pushing on from Paxos is around what we call multi-jurisdictional compliance. And that is around how we can create a stablecoin that's regulated, that is compliant across different regimes, but it remains global and fungible. So someone from the US can send it, and someone in Europe or APAC can receive it, and that is a regulated financial instruments across the globe, so it can actually be and fulfill the promise of global infrastructure. If you think about it, in some ways, the EU regulation with MiCA really introduced sort of this first major threat to this global promise of stablecoins. They require that for any stablecoin in circulation in Europe, the reserves be held in Europe. So a stablecoin issued by someone in the US, by an institution in the US, can no longer be actually used in Europe because the reserves need to be held in Europe. So really the work is around how do we create a stablecoin that is both regulated in a jurisdiction like the US, as well as in Europe and other jurisdictions. As more financial centers across the globe introduce legislations, this sort of tendency to try to bring the reserves and the fiat aspect backing stablecoins into its own jurisdictions create this tension. Creating this global framework, it's actually relatively complex in some ways. It requires global regulatory coordination across all the major regulators, and it also introduces challenges across how do you generate accountability for the reserves of the stablecoins across different entities. In scenarios where there is no financial stress, that's relatively simple to do and to regulate, but obviously regulators are always focused on how do you manage and mitigate instances of major financial stress. So how do you then create accountability across the different regulatory regimes for managing through a situation of global financial stress? There are also different consumer protections across jurisdictions And then how do you introduce that into a global product, not a product that's jurisdiction by jurisdiction? And this is sort of, we see this layer of global regulatory compliance for a stablecoin as being critical for the success of the promise of being truly a global layer of money movement on which anyone can build without sort of going back to fragmentation. Because the moment we have each jurisdiction with its own regulation and its own stablecoins, then we're back to, in many ways, to the fiat world, where we have fragmentation in terms of acceptance and in terms of fungibility of the assets.
Okay, thank you. Mom?
Oh, sorry.
Oh, it's okay. Well, thank you. Nice to meet everyone. Thank you for having me. Yeah, just kind of touch a bit upon two topics. One is, I think, talking quickly about the obvious as to, hopefully by now, why stablecoins have gained a lot of prominence, because it kind of touches on what Horacio mentioned. Like, the current rails in the financial system are slow, they're expensive. The cost is kind of, sometimes prohibitive, depending, especially for microtransactions. Finality and settlement takes a ton of time. Cross-border, if anyone has tried to send money overseas through traditional rails, have experienced $25, $50 fees, then FX rates on top of that. But then the last one, I think, which is why, and this is kind of dear to my heart, I'm from Lebanon, Beirut, where we experienced hyperinflation and people were trying to figure out, where can I park my money? Stablecoins have kind of risen in those jurisdictions, in those areas where access to the dollar, a seemingly safer place for me to park my funds, made much more easier, right? So I think that's kind of the main reason why it's in a way the killer app of blockchain and digital assets compared to kind of the original thoughts about it. Same as how SMS really helped mobile phones kind of became a killer app as well. I think stablecoins is kind of what is truly reaching product market fit for the digital asset space. I think there's really one main, from my discussion up front, topic I want you to all think about, and I think this is where Professor Amit kind of touched upon a bit. The original also genesis of the digital asset space and the crypto space was kind of anti the traditional finance, and it's kind of a revolt against it. And I don't think we're at a stage where it's either or, and I think Professor Amit mentioned it, kind of, it's a matter of when and how these things will coexist. And from our perspective, in a way, the stablecoins and the digital asset system depend on strong banking. They're not here to kind of necessarily replace it in full, but their success is kind of dependent on it. So if you touch a bit upon what we do at LEAD, we are a community bank in Kansas City, and but we offer platform APIs and financial infrastructure for fintechs, digital asset companies, stablecoin issuers, all of folks that want to operate in the system. And our job is to kind of really help them blur the line between fiat, digital asset, because at the end of the day, the average consumer cares a little bit less than the rest of us here nerding out on it, what the actual stablecoin is, what is it USDC, is it the Paxos stablecoin, is it USDT, as long as it's some that has a solid value, I can redeem it, I can spend it, I can move it, I can do the things I want to do with it, right? How it's ledgered at the end of the day and where it sits is somewhat less relevant as long as the consumer protections in a way around it are there. So that's what I mean here. Like, stablecoins depend on strong banking, right? So whether we want to issue a stablecoin, redeem it, and all of the reserve functions are still traditionally a bank function, if you will. The issue I think we've run into up until now is not many banks in the US have the technological, operational compliance mindset and the ability to kind of adopt sometimes rules and laws from the 1970s and apply them to kind of today's environment, right? So that's where, again, there's a bit of rub. The other important note here is in the absence of some universal kind of tokenized identity, if you will, right? The compliance and the identity lives at the boundary of the wallet and the bank account, right? So this is where all of the checks and balances are done on the end user, who it is, what they're doing, why the money's circulating, for what reason. That happens when you're on-ramping into crypto, if that's the term you've heard. On-ramping means I have $1,000 in my bank account and I would like to convert them into some token that sits on the blockchain, USDC, USDT, Paxos USD, whatever it is, right? That's an on-ramp. And that's when typically, again, money enters the financial system, checks happen, identities kind of codified, and then the money can move on the blockchain. Does that make sense? And then the last topic, again, is we see today a lot of the stablecoin issuers are some of the largest holders of treasuries in the world. And so that, again, creates significant interlinkages between the digital asset world and the traditional finance that we cannot just it's not a binary anymore. It has to coexist and work in a seamless manner. But the main issue I think that we are trying to solve also at LEAD and in this space is kind of a little bit of what Horacio also talked about. Stablecoins are very good in my mind at moving value instantly from me to you. But then for you to extract that value and do something with it, Professor Amit talked about the last mile issue. You have $1,000 USDC. What are you going to do with it? Not many people accept it. If you want to spend it, you have to either off-ramp back into a bank account, et cetera, or find these kind of weird multi-step hops, which then make it slow, expensive, friction-laden again, right? But that's where kind of we're pushing, for example, and what's top of mind for us is, a good example is back in December, we issued with the support of the Bridge team, who's now part of the Stripe ecosystem, stablecoin-backed card, and then that card we settled directly with Visa and stablecoin. So that means that the stablecoin that a user has in their digital wallet now completes a circle and goes from the card itself, the wallet where the account sits, straight to Visa. And that kind of provides utility to that stablecoin. I don't have to then convert it and send it back to my fiat bank account, et cetera. So really that's top of mind for us, and that's, again, what I'd encourage folks to think about is it's no longer a binary, it's not digital assets against banks. There's some friction, especially with some of the laws that are still being drafted on yield and rewards and et cetera, all of that, there'll always be friction, but it's a matter of how these two systems can coexist. And in a lot of ways, instead of kind of the digital asset replacing the banking system, it's the digital asset ecosystem kind of borrowing some of the qualities of the banking system around, again, consumer protection and some of the things you can do.
Thanks.
Thank you. Thank you for having me here. I'm going to talk a little bit about the financial stability risks associated with stablecoins. They're designed to have a $1 peg. We've heard they're backed by a lot of treasuries. And so there are definitely things to think about in terms of financial stability because stablecoins lose their pegs all the time. People usually talk about the prospect of a stablecoin run triggered by losing its peg using kind of a classic bank run framework. But that framework assumes that people consider stablecoins to be a substitute for consumer deposits or a traditional payment mechanism. And that's never really been true in any meaningful way, as you can see from this slide here. So the Genius Act about stablecoins that was enacted last year was labeled as an act about payment stablecoins. But as you can see from the Federal Reserve data, in any given year since 2021, no more than 2% of any American households have used any form of crypto, including stablecoins, for even a single payment. Payments methods are sticky. It's hard to get consumers to change their financial habits. And there's really nothing much about stablecoins right now that is compelling. Unless you count the fact, actually, I'm going to flip a comment that Horacio made a little bit. Blockchains are actually incredibly inefficient compared to regular databases for payments processing, unless you're using them to avoid local laws and complying with local laws. There's a lot of frictions that come with having to comply with local laws. You can eliminate those by switching to a technology that everyone agrees can't be regulated. But it's inevitable that whatever technology you use, once you have to comply with multiple regulatory regimes, frictions are going to be introduced. And then, frankly, you're just better off with a classic database, which is much more efficient. So there's not really efficiency gains for consumers. When consumers adopt stablecoins, they're forfeiting consumer protections, particularly deposit insurance, particularly the ability to reverse transactions. So what really would juice consumer adoption of stablecoins? The way I see it, there's a couple of things that might encourage mass consumer adoption. It's not guaranteed. But one is for crypto exchanges to start paying significant amounts of rewards to stablecoin users. That's why the yield debate that's currently going on with regards to the Clarity Act. It's sort of a fight between the crypto industry and the banks is such a hot topic. The other path potentially is for the giant tech platforms like X and Meta to launch stablecoins as part of their ambitions to build Chinese-style everything apps. That's something that the Genius Act laid the groundwork for. So really, it's only with a little help from Congress that stablecoins might succeed with consumers. If it does, we may see consumer runs, but something that's missing from the usual story about stablecoin runs is that for most stablecoins, consumers lack contractual redemption rights. This is really poorly understood. But basically, if you want out as a consumer from a stablecoin, you have to go on an exchange and hope someone will take it off your hands at whatever price they're willing to give you. You don't get to benefit from the peg. That's very different from bank deposits and money market mutual funds, where you are contractually guaranteed to get $1 back, at least on the deposits for the dollars. Money market mutual funds is a little different, but you at least have a contractual right of redemption from the issuer itself. So in many ways, consumers can't run on a stablecoin, and that's often missed in financial stability analysis. But that's why it's so important to focus on the institutional market adoption of stablecoins, because institutions do have contractual rights to redeem stablecoins direct from users, and so they can run on them. So the primary legal use case, as you can frankly see from this slide and also from this slide, is that stablecoins have always been sort of an adjunct to crypto speculation, the poker chips in the crypto casino. Stablecoin demand has been linked for, as you can see, during the 2023-2024 crypto winter, demand for both dropped. Once Trump was reelected and there was an interest in crypto speculation again, the stablecoin market came back. I was just at a digital assets conference in London where there was much consternation that the stable market capitalization has largely flattened, stagnated around 300 billion since November's crypto crash. But there is a push to get more demand for stablecoins, and it comes in the form of tokenization of real-world assets. So once on a blockchain, transactions in both traditional and crypto assets can be settled using stablecoins, and the industry is betting that institutional interest in tokenization will expand stablecoin demand. So if stablecoins do come to be viewed by institutional players less as poker chips and more as a settlement asset in traditional finance, then institutions will presumably be far more sensitive to stablecoins losing their dollar peg. We could start to see more runs on stablecoins, particularly if there's turmoil in crypto or tokenized asset markets, and blockchain-based transactions settled in stablecoins could start to be unwound en masse. And so stablecoins' financial stability risks, which have significant impacts potentially for the treasury markets if they grow large, given their holdings of treasuries, that's something that is intimately tied to the tokenization project.
Thanks. So, as I said, there is going to be a wide variety of views here. So why don't we try to see where there's convergence. So, Horacio, you mentioned quite a bit about interoperability. But can a globally interoperable system exist if every jurisdiction is going to have their own regulatory structures and reserve structure? Does it blunt what stablecoins' potential really is, or how do you see that?
Yeah. That's the work that we're doing around multi-jurisdictional compliance and driving collaboration across global regulators is focused on, is to avoid that. If each regulator is going to look inwards and push for or drive specific regulations and holding the reserves back in the stable coins within their jurisdictions, is going to be very hard to drive a global fungible stablecoin. There will be unregulated stablecoins that can achieve that, but regulated stablecoins will not be able to, because to serve the European market in a regulated way, you're going to have to hold reserves in Europe. To serve the US markets in a regulated way, similarly. And, while the DPEG risks are material, in fact, I don't think there has been a regulated stablecoin that actually has DPEG. Paxos is, until recently, was the only regulated stablecoin issuer globally, and we've never had a DPEG of our stablecoins. They've been unregulated stablecoin issuers that obviously bring a lot of risks and lack of consumer protections, and those have depegged, and there is significant risk around those. Doing so in a regulated way mitigates a lot of those risks because there is lots of constraints on how we are expected to manage the reserves, where we're expected to hold them, to bring certainty and predictability to the financial markets.
Can you give, because not everybody might know about this, but let's take PayPal USD.
That's right.
And if there is interoperability friction, can you give an example of how it works? And
Take PayPal dollar, which is issued by Paxos on behalf of PayPal Group. It used to be New York Department of Financial Services regulated stablecoin. Paxos issued that asset as a trust out of the NYDFS. Today it is issued out of our National Trust Bank, regulated by the OCC. PayPal US dollar today is not accepted stablecoin in Europe because it is not a MiCA compliant stablecoin because the US regulators and the European regulators have not agreed on a joint regulatory framework. Paxos is also, the Paxos Group is also the issuer of the global dollar on behalf of a network that includes Robinhood, Kraken, WorldPay, MasterCard, 150 plus firms across fintech, crypto, and some traditional financial institutions. That asset is regulated both across Singapore and Europe, so it is actually multi-jurisdictional in nature. We've sort of worked with regulators to start developing, and there's still plenty of work to do to get to a final state, but to have an initial stance around how we can have an asset issued across 2 jurisdictions. And we're now working with the US regulators as part of Genius rulemaking to be able to bring PayPal to Europe, to bring the global dollar to the US, and truly have global stablecoins from that perspective.
okay, so this might sound familiar if you are into banking and have heard of Basel regulations trying to coordinate and standardize things. It's probably going to hit similar kind of challenges. So to Homam, you talked about the last mile problem. So let's focus on the US system itself now. So the stable coins, you're dealing with the traditional financial system. So where are the biggest frictions that you're seeing today? Like, are they in compliance, settlement, reconciliation, onboarding? Like, I'm just trying to see, is AI going to solve any of this?
Yeah, so some of the risks with, or the friction points, and to some extent kind of the points that Hilary made, friction is not always bad. Like in a consumer mindset, usually you might think, oh, I don't want to have to click a few extra buttons or whatever, but usually some of these buttons are there to provide you in return kind of some of the protections you expect if something were to go bad, right? But the types of friction or the issues that we see is, again, a little bit about interoperability, and not necessarily from a compliance jurisdiction globally, but even let's say there's the PayPal stablecoin, and there's USDT, and then there's the lead bank coin. Let's say at some point those don't talk to each other, right? As individual, it's not a net new problem because today, let's say, it's a good example. You have money in your Venmo account, and then a friend of yours is on Cash App. I'm sure now you can do it, but at one point in time, you couldn't send money between Venmo and Cash App. That's the equivalent of the Venmo stablecoin, the Cash App stablecoin not being compatible, right? So back to kind of the comment that Hilary made, that was a Venmo database of ledgering kind of value, a Cash App database that don't talk to each other. At some point, someone needs to build a bridge so that these 2 databases talk to each other. It's kind of a lot of the same when we talk about interoperability of stablecoins, but where we kind of focus more on, because we're not fully on the digital asset side on the blockchain, it's more real world use cases. I have value, someone is telling me this is worth $1,000, and let's say it's regulated and approved by the government, right? I still can't use it the way I'm used. I can't write a check against it. I can't send it to someone's bank account immediately without adding multiple hops in between. So it's that friction that gets solved by technology, but then the issue typically is that involves multiple parties. And then the traditional bank, and this traditional kind of bank partner model, let's say where the underlying bank works with a third party, the banks have not been good at overseeing the activities of those companies, and money is now moving at a velocity that the traditional ways of risk management, sampling, checks and balances on a monthly or weekly basis, you can't do that anymore. It has to be reconciled. A lot of that is around velocity of the money, making sure things are reconciled in a way to the penny at the time of transaction, understanding where the money is going. And then, so for example, even though we are largely on the fiat side, we use chain analysis in our, and chain analysis, by the way, for those that don't know, is a tool that you can use to do forensic investigation on the blockchain to understand kind of where the money is going. Is this a wallet that is sanctioned or that is tied to kind of illicit activities, right? So that's the issue, is kind of, again, what I mentioned in my opening remarks, bringing a lot of what the traditional financial system does onto, in a way, the blockchain is kind of the friction of where we're still at, if that makes sense.
Hilary, like you raised a lot of questions about this, the problem that we are trying to solve. So if I were to flip your opening remarks and ask you instead, where do you think is the strongest use case? Because I think the way I interpreted what you said, that there's a lot of enthusiasm which is probably outrunning economic substance. So is there a use case where you think there could be
stablecoins,
yeah,
blockchain?
Stablecoins, let's say.
No. Honestly, I don't think there's anything that can't be achieved better with either some form of tokenized deposits or some kind of, wholesale central bank digital currency or something. I think, stablecoins evolved to solve a particular problem in the crypto ecosystem, which is that crypto is enormously volatile. And so if you wanted to have a cash management tool on the blockchain without having to take your money out through an exchange, et cetera, you needed a place to park your funds between investments, or you needed something to serve as collateral for crypto loans. They needed a more stable form of crypto. And so in that sort of small universe, it makes sense, I guess. But I don't think that there's really a real world need for it at all. And given the fragilities in the business model, I think I've been calling for stablecoin bans for years. I sat on the Senate floor in 2022 and said you should ban these things. Unfortunately, that's where we are. We are where we are in large part. And actually, are my slides still available? I have an extra slide I wanted to show.
By the way, what about tokenized assets?
I can come back to that. But there's a slide I had, and there was a recent Politico reporting that came out in the last week or so. There we go. Last one? One more? Yeah. So Politico poll reporting came out in the last week or so, where they acknowledged that voters aren't interested in crypto. Voters don't trust crypto. Voters don't care about crypto, and that everything that has happened with Genius and Clarity has been driven by political spending, by industry, and not by actual sort of consumer preference or demand. So I think it's important to think about what's happening in that light. In terms of tokenization, I think that's a more complicated conversation. I think when we think about tokenization, we often associate it with blockchain, but tokenization doesn't need to be on a blockchain. In fact, you can just use a regular database for it. And then there's some functionality that comes from the smart contracts, from automating tokenized assets, and that can live on any kind of database. And there, you've got your classic pros and cons, right? Making any system more efficient inevitably introduces more fragility, as you mentioned. So there are trade-offs. In certain asset markets, it makes sense to tokenize, to automate certain functions. In other markets, it doesn't because of the fragilities. So I do see that there is some use case in tokenization. But again, as I said on the floor of the House Financial Services Committee, it shouldn't be happening on public permissionless blockchains because of all the operational risks that come with those. You can tokenize on any database.
And what about the whole argument that, like, if you look at the banking sector, over the years, it's like run like a monopoly. So there is a lot of gains here which the banks are eating. And all of this is a good way of introducing competition into the system. which might actually take the surplus away from banks to the consumers.
Well, there's more competition in banking than there is in stablecoins. Like basically, the stablecoin market is two players. It's Tether and USDC. And Paxos, no offense. But in terms of sort of who the big players are, it's two players. And Silicon Valley platform companies tend to monopoly far more than you see in banking. So I just don't find that a compelling argument.
Can I
Yes.
jump in?
I'm hoping that the two of you are going to come back with something.
I like to, I think this is a great slide in some ways.
Yeah.
And I think something that Lisa mentioned, there's no doubt that sort of, if you look at stablecoins, I think even 3 years ago, I joined Paxos 3 years ago, and at that point in time, stablecoins were basically a factor of the crypto business, crypto trading, crypto exchanges. And there was this like glimmer of hope, hypothesis, a thesis, that there may have a role to play outside of the crypto world, but it wasn't obvious at all. And I had spent the almost 20 years of my career before that actually working on financial infrastructure. I knew nothing about crypto or blockchain, but it was sort of that glimmer of like thesis that stablecoins may play a role in sort of upgrading financial infrastructure that drove me to sort of join Paxos 3 years ago. If you now 3 years back, if you look, and I'll be curious to hear the perspective from Leadbank. If you look at Paxos, crypto markets are, depending if you're generous, 30 to 40% down, in some cases 80% down from last year, from October of last year. Our stablecoin business is 10x this year what it was a year ago. 90+% of the conversations we are having are not with players on the crypto industry. We're talking primarily with the largest banks in the country who are either looking to issue a stablecoin so they can upgrade how they go about their business, or they are looking to leverage others' stablecoins to upgrade how they go about their business, whether it's capital markets work, whether it's cross-border transactions on the consumer side or on the business side. Our treasury team at Paxos, and we're a crypto stablecoin company, so yes, of course I would expect this. We manage our treasury entirely on stablecoins globally across almost 20 entities. We had one of our corporate clients, this is a Fortune 100 company, who moved a bulk of their corporate treasury functions to stablecoins, and they took processes that were 3 weeks long to 3 hours. So I think the narrative in the field has quite rapidly evolved over the last 3 years, beyond it just being a crypto, sort of way to get out of speculative assets and sort of hold value. And I'm curious to hear whether what you're seeing on your side, I suspect is somewhat similar.
Yeah, so I think from our perspective, on this also, I would expect this relationship for sure because a stablecoin is the native settlement mechanism for a trade on exchanges. Mm-hmm. I think the question is if you back out trading volume and look at the, however small, I do think it's growing at substantially fast rate. So there's good indication that usage for non-trading activity is growing. It's still nowhere near anywhere to kind of challenge existing rails, no question about that. Second is we're starting to see, like I mentioned again, this stablecoin-backed card or some of the other use cases that bridge normal consumer behavior with the underlying stablecoin tech for a variety of reasons. I would fundamentally agree that the average consumer, again, will not care necessarily about stablecoin. Just the same way if I say, like I mentioned the Venmo example, you have money in your Venmo, technically it's as if you have a stablecoin. That is the Venmo stablecoin. You just don't think about it because you expected that it will operate the way you want it, right? So that's how I think about at least stablecoins versus tokenized deposit. There will be a land for both. Tokenized deposit will be, I want to keep my money at a bank and I would like to be able to use it in some other form, right? On a digital blockchain or another database or whatever technology it takes. Versus I am my own company and I would like to kind of control a bit more the settlement mechanism and the money within my network, then I kind of need my own database or my own stablecoin, right? It's all, we're talking about the same thing. But we're seeing, and I think we see a lot of growth also in the cross-border space with has, I think, a nice name, a stablecoin sandwich, which is fiat in, stablecoin to cross-border, and then fiat out, right? So people are trying to use it not necessarily to subvert laws, but then to, take an end-to-end process and then maybe shave 2 days off of 3, and then be left with a 1-day settlement, let's say. Does that make sense? So there's a lot of these use cases in terms of products being used by end consumers and pure payment and settlement mechanism that, again, if you were to back out the correlation, you'd see actual growth. There is growth. It's still not life-changing, if you will.
Okay. I have a bunch of questions, but we have a lot of expertise on the floor. Mm-hmm. Why don't we open up the floor for some questions? And if you all don't have, I have a ton. Let's take a question there.
Thank you so much. Sandra Wallachek, I lead the blockchain digital assets work at the World Economic Forum. Really appreciated the debate and discussion here and the variety of opinions. If there's time, I have 2 questions, but we could also just answer one. So first, for Horacio, I'd love to expand a little bit more on what you mentioned with the joint liquidity pool and how that would work in reality. Is it kind of a CLS-based model, doing the FX payments between the different currencies? Would love to hear more. And then from Lead Bank, would love to understand your opinion where you mentioned that stablecoins are the killer app or the main use case, but looking at the graph that was shared with the 1% of users using stablecoins as payments, what would it take to see that growth in individuals using stablecoins?
So the rule is 1 question, but you got 2. That's okay. As you answer, you may want to simplify, because otherwise this will be like discussion about the vintage of wine.
So the world that we're trying to sort of help bring regulators globally is, let's assume we have one stable coin, let's call it Stanford USD, that's $100 globally. And we want that to be regulated across 3 jurisdictions, the US, Singapore, and Europe. Whomever the issuer is, let's say Stanford University, will have should need to have an entity in each of those jurisdictions regulated by the relevant prudential regulator. Then the question is, how do you have a consumer-facing product that is $100 that can be held by anyone in the world, while underneath on the fiat side you have reserves for across 3 different regulatory regimes that need to be held to different local bankruptcy laws, different guidances on how the reserves of the stablecoins need to be held, and create enough collaboration and comfort across the regulators such that if one of the entities, for whatever reason, goes bankrupt, which is what always regulators are worried about, how consumers globally are going to be made whole, independent of what may happen to one of the separate entities that's issuing the unified global stablecoin.
Thank you. Lead Bank?
From my perspective, again, adoption relies in a way less so on the end consumer deciding they want to use stablecoin, but then their pain points and use cases being solved more efficiently using the technology. So let's say you have your app and then your bank account type app, and it advertises you can send money to Europe and settles in 5 minutes and then for 5 cents. You'd probably use that over traditional rails, right? And if underlying that, that's what I mean, where when you start to kind of make the friction go away with the proper controls, then adoption will come, right? Today, for example, you can send money between the US and Europe and whatever through Wise and Remitly and Revolut and a bunch of others, right? But what they are doing is maintaining liquidity pools on each side of the globe. They'll disperse, you click it in your app here, they'll disperse immediately in Europe, but then money takes 3 days to settle, and they're having to manage this treasury, and that comes at a cost to them, right? So as the end use case for the consumer is solved with this potential technology, then adoption will come. But if we still look at it as what's your stablecoin strategy, for example, it's not gonna go anywhere. Does that make sense? So that's why our job at Lead, and I keep emphasizing, is to blur the lines with the proper protections to the consumer, so that then the technology can be adopted appropriately.
If I can add one comment there.
Yeah.
If I put my sort of Paxos hat aside, I share this. I think stablecoins will be successful, or will, we're going to think of stablecoins as successful the day we're actually not talking about stablecoins. It's just a more efficient piece of technology in the background that no one is thinking about. Consumers shouldn't have to think about, USDP, USDT, or whatever other stablecoin we are thinking about. That's for people on the infrastructure side to worry about.
Jigwa, Professor Jigwa here.
Thank you so much. My question is to Homam, but obviously to others. So one focal point when I read all these things, I'm teaching at the GSP, I'm a colleague of Amit, is that the wallet level identity. Okay. So, as you said, that when I started to have a public address, get a wallet from a issuer, yes, you can do KYC, but later on, who knows? One way that the BlackRock and all these, they do whitelisted way to control it. And I think there's a lot of controversy on whether this is correct or, to the level of a regulatory, or the other side will say, if you do whitelisted, then it means that you control everything. That seems to be very hard to address. It's like at the center of a conflict between the anonymity versus the KYC area. As someone who works in this area, and it seems like that's the thing that immediately gets into this issue, how do you think that you want to convince the regulator not to do the wallet level identity, or you think that they should do the wallet level identity?
So I'll tag on to that question so that then we can just have all of you answer. So on top of that, what's the biggest policy mistake each of you think that regulators could make over the next 2-3 years? So answer his thing and then that too.
Yeah, I have less perspective or opinion from a policy level, if you will, how it should be implemented. But I think the whole notion that, the blockchain is anonymous, it was both a feature and somewhat a bug also of that technology system, because back again, if you want consumer protection, if you want to be able to have insurance on your things, you want to do the things you expect, it can't be anonymous necessarily, right? And then I am a bank, I'm a tech forward leaning into this bit, but I'm still a bank. I need to know who's doing what are they sending money, etc. Right? So that is top of mind for us, whether it's implemented at the wallet level or we use other forensics tool to probabilistically estimate who's who, and is this a sanctioned wallet? Is this going to Venezuela? Is this going to North Korea, right? I have to do my job, right? And then I will be responsive to kind of whatever policy but I can't not know who's doing what when they're using my financial system. Does that make sense? On the policy mistake, maybe a self-serving one would be if yield goes away from banks and into... No, but then it makes it very difficult for banks to participate in the ecosystem, right? If that's the main kind of engine of the banking system today, is being able to generate yield off of deposits.
Right.
So if I can just quickly jump in on the last question, and then also,
sure.
I think your question is a really important one, and what it illustrates in all of this is that the technology isn't the hard part, right? And that there are multiple different technologies who could serve the same purpose. The hard thing is getting multiple regulators on the same page from multiple countries, that they are all comfortable with a system, right? And that has nothing to do with blockchain. Those challenges you'd face them with anything. And so the hard part is not the tech. It's the sort of the regulatory harmonization. As you mentioned, Basel. In terms of regulatory challenges, I think I'll make a very sort of meta comment. The challenge that I often have is that financial regulators are not comfortable interrogating hype about technology. They're happy to analyze the sort of the economics of a business model, but if they're told this technology can do X, they just accept that. And in fact, there's all kinds of operational risks posed by this technology that just have gone completely unaddressed in Clarity, in the bill that's being debated, in Genius, because they just sort of accept the talking points that, the blockchain just heals itself and manages itself, right? They accept certain talking points about decentralization, which are, not true in the crypto ecosystem by and large, where you have very significant economic concentration. So my concern is that we will get bad policy because financial regulators are too afraid to engage with the actual tech itself.
Okay. Last word.
I think the biggest risk is in the policy side is not actually making progress towards some policy. I think the biggest enemy of having something that's good is trying to not make progress. I think we just need to make progress. We'll iterate and we'll make it great over time.
Okay.
That would be my
So
answer.
in 2 years, when we do this panel again, we can have this discussion again. Hopefully, we have a test case to discuss. So with that, I would like to thank the panelists for a great discussion, even though we didn't converge. So thanks, everyone.